Happy Thursday. We have a lot to cover here this week. We've got inflation and the Fed all at once. And our question of the week is going to be all about inflation as well, thanks to you and your votes here in my poll recently. Obviously, that was a big concern and one of the things that you guys felt was the most risky to your portfolio. So we're going to be talking all about inflation here in this week's market update. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal is to bring to you the market news, trends, data, things that we're watching every week, and hopefully weed out some of the noise to bring the stuff that really drives decisions or actually matters as far as your portfolios. It is definitely the holiday season around here. It's actually, I think it's supposed to snow today, and things have been extremely hectic. Although you would think this time of the year gets a little slower, it never really does. So hopefully everyone is enjoying the lead up to 2022 here and not running around too crazy. All right, this week is just full of inflation and Fed and interest rates and all the above info. So we're gonna just get into it here. Last Friday is where it all started. Friday, we had consumer price index come out at up 0.8% again for the month of November. It's a huge number, right? That even with the inflation expectations we all know are out there, the expectation was only 0.5%. And again, it beat that significantly. It came out at 0.8% in 1 month. So inflation is still here. It's still running extremely high. And on top of that, we also had producer price index come out at 0.8%, same number as well. And I apologize, the expectation for consumer prices was slightly less. It was 0.7. The expectation for producer prices was 0.5. But either way, the actual number that came out for both categories was 0.8% for the month. Huge jump on top of what we already know are significant price increases already that we've experienced. So inflation's here. I'll talk here in a minute, tip the cards a little bit, but the Fed is maybe starting to admit a little bit more that that is a bit of a concern. So we're going to be talking a lot about that today too. On a separate note, before we get all into the Fed data, on Wednesday before the Fed conference, retail sales came out only up 0.3% here versus expectations of 0.8. So a little bit of a pullback in retail sales. Now, keep in mind, this is for the month of November. Obviously, as we move into the holidays, we may see that pop back up. But, to know that inflation is still running and that number pulled back, it's possible that maybe people are getting a little more nervous and maybe not spending, as they used to. So that will be very important to watch. Probably expect a jump in December because it is the holidays, but as we move into the new year, that will be something we'll really be paying attention to. Make sure that spending is still happening, because if it's not, that will tie into some of the problems we'll talk about too. All right. And then yesterday on Wednesday, again, as always, when the Fed's in the news, that's all we care about. I mean, that's like where all the media takes us. That's where everything goes. And rightfully so, because we have a giant inflation problem. Interest rates are extremely low. Money is extremely loose. And here we are still with all those same problems and inflation just running out of control. So the Fed has a lot of tools in their toolbox to handle a lot of that. And basically what they have decided is to use some of that more aggressively and really implement some of that moving into 2022. One of the things is that they have decided that they're going to double the speed of their taper. So rather than, I think it was 15 billion a month that they were going to kind of pull back, it's now 30 billion a month. Now, I want to stress this because this is really important. When they are pulling back on these asset purchases, know that this is money going into the economy that really shouldn't be there in the first place. So when they are slowing these bond buying programs, it doesn't mean they're pulling money out. It means they're putting less money in, right? So really keep that in mind. To be doing that in the first place is still a little bit maybe beyond me, given what we're seeing. We have inflation concerns, and yet we're still going to be putting money buying bonds individually. So something to pay attention to there. And again, I don't think that the speed of slowing that has a huge impact on what we'll talk about here in the markets in a minute. Second thing, though, which may have a bigger impact, is that the Fed is now officially talking about 2 or 3 rate hikes in 2022. I think for a lot of us through most of this year, we believe maybe one would come just with the way the Fed talks. I personally believe that we probably should have done this at some point sooner, to handle some of this inflation concern. But here we are. It's something that they have only talked about, possibly doing one in 2022. Here we are now as inflation puts more pressure on them, and we're talking about probably three through the year of 2022. Obviously, that will change. It may be two, it may be four, it may be one, depending on what happens from here. But that's the latest, which is, again, very, very new news there. And on top of all this, which you might think on the surface seems like bad news, the markets were actually up over about 1% on Wednesday at the close. So what does that mean? I think what is probably happening, and I'm really excited to see what happens through the end of the week and moving into next week, but I think that maybe a lot of people, similar to you, have been concerned about inflation. And so maybe this is a little bit of a sigh of relief, knowing that at least something is being done to handle inflation before it gets out of control. Although, that's up for interpretation. So that might be kind of why we saw that reaction from the market quickly there, but we'll see how that pans out as we digest a bit. In the press conference, it was very interesting because, again, even more of a change in tone from Fed Chair Powell. He said the real risk of inflation, the real risk of inflation is a concern now. I believe that was pretty close to what he had shared. And this is not something he's ever talked about. He's always said it's no big deal. It's transitory. It's going to go away. First time he's sharing that it is actually a concern of theirs and something that needs to be addressed. Yet, on top of that, it says, wouldn't say that they're behind the curve on inflation, which I don't really understand how you can say that when, again, we just got a monthly number of 0.8%. The big pivot was that the Fed has completely changed their tone, yet they still won't really admit that maybe something should have been done sooner or that, anything's been done wrong. I think the inflation numbers may dictate otherwise, and obviously this will be something that's looked at. But regardless, that's kind of where we stand today. And I want to talk a little bit about what this all means for inflation and really our question of the week here in a minute. But as we move into next week, we will have GDP numbers coming out, consumer confidence, which will be very interesting to see based on what we talked about a minute ago with the retail sales number. And then next Thursday, I believe it is, we have income, spending, and core inflation all coming out that day as well. All right, before we break here, I want to spend some time on our question of the week. And I want to thank all of you because this comes from all of you and your responses to my poll here recently. I had asked you basically, what is the biggest concern? What is the biggest risk to your investments or your portfolio today? And as a result of that, really the top answer was inflation. Surprise, surprise, I guess, right? So as a thank you and to address that, I wanted to kind of touch on that here in our question of the week this Thursday on the 16th. So what I'll say is that obviously this ties a lot into the Fed meeting today. Inflation, rightfully so, is a big concern. I am totally with you on this. I think it's a big concern, especially if it continues. And there certainly are no signs of that slowing. Now, the reason the Fed meeting today was so dang important is because some of these tools that we're talking about are really designed to help slow inflation to some degree. So if we raise rates, typically that can help slow that price movement up. If we stop buying assets and adding more money into the economy that already has plenty of money in the economy, that can also slow down the growth of the price of assets, right? Now, I guess it's a good sign to see this. Again, I think that's why we saw that market reaction. That said, what I am a little bit concerned about with this is that it may be a little too late. And the reason for that is inflation in and of itself is not necessarily a bad thing. If inflation is paired with growth, with economic growth, it's not a terrible thing, right? Yeah, things may be more expensive, but if we're being more productive, we can offset that higher cost. Now, where the real problem lies is if inflation continues up and our economy kind of fizzles out, either stays flat or barely grows or whatever you may want to call it. That's what we call stagflation. You probably heard that term before. If not, you probably will be hearing more about that in the months to come. But stagflation is really the concern. Again, higher prices and no growth in the economy. That is what I'm concerned about. And the reason I bring that up is as interest rates rise, that is something that can slow the economy. So rather than doing it at a point where we really need some growth, I think that this probably should have been done a ways back. get ahead of the curve of inflation now that we're at the, I don't want to say the tail end because I'm not trying to say that necessarily, but now that we've seen a few years of growth out of COVID, it may be a tough time to start raising rates on top of a period where we do need to continue to see significant growth really moving forward, especially with the inflation concerns. So I think, you guys all have a very, very good concern around this with the inflation considerations. Some of these measures, again, from the Fed this week should help minimize that to some degree, but it also adds the potential concern of stagflation. So I am not worried about this right ahead of us. And I wouldn't suggest necessarily making radical shifts. You may want to get ahead of this and hedge your bets to some degree, hedge your risk to some degree, but it's not something I see that's going to like really just flip a switch tomorrow and all of a sudden we have challenges. Maybe a year or two, whatever it might be. It depends how things unfold. That's where I start to see a little more concern. So it's just something to watch very, very carefully, and how all these programs and these different tools are rolled out will probably dictate a lot of whether or not that is something that needs to be really addressed in your portfolios, or maybe handled in a different way where you can maybe reposition into assets that do better in that inflationary period. So I hope that helps. Again, thank you so much for your participation in the poll here. We wanted to make sure to thank you and answer it because a lot of you had inflation as your top concern for your portfolios in the near run and moving into 2022. Thanks so much for joining us. Let us know if you have any questions. Feel free to comment below and I'd be happy to answer them in our upcoming session next Thursday. Otherwise, have a great weekend and we'll see you next Thursday at 3 p.m.